Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Fed policies pause confirmed. Markets priced in a 97 to 98.9% probability of no rate change at the March 2026 meeting, according to CME FedWatch data, and that's exactly what we got. Federal funds rate holding at 3.5 to 3.75%. The question now is what this means for your positioning across equities, bonds, and digital assets as inflation refuses to cooperate with the Fed's 2% target. Let's cut straight to the inflation picture because this is what's driving every decision at the Fed right now. Consumer Price Index currently sitting at 2.4% year over year. That sounds manageable until you look at core personal consumption expenditures, the Fed's preferred gauge. Core PCE elevated at 3.1%, which represents a full 1.1 percentage point overshoot of target. According to data from TrendForce, this marks the third consecutive increase in core PCE year-over-year growth. Fed Chair Jerome Powell explicitly called out persistent underlying price pressures during the March meeting, citing tariff impacts and oil price volatility amplified by ongoing geopolitical tensions. Fourth quarter 2025 GDP revised down to 0.7% annualized growth. That's a significant downshift showing economic softening at the exact moment inflation remains sticky. This creates the classic Fed dilemma: cool the economy enough to bring inflation down without triggering a hard landing. Bond markets are reflecting this tension in real time. The 10-year Treasury currently trading at around 4.28%. The 30-year Treasury elevated to approximately 4.91%. According to analysis from A-Invest covering the Fed's March meeting, market participants are closely watching whether the 10-year yield breaches critical technical levels that could force a major repricing event across all asset classes. That 30-year yield pushing toward 5% is particularly notable. It signals bond traders are demanding significant inflation premium for long-duration exposure. The yield curve dynamics here matter for your equity positioning. Treasury rotation opportunities are emerging as traders position for potential curve steepening. Exchange-traded funds focused on long-term treasuries are seeing tactical interest from institutional players adjusting duration exposure. If inflation expectations remain elevated and the Fed stays paused, you could see continued pressure on long-end yields, which would ripple through equity valuations, particularly for growth-oriented names. Speaking of equities, sector rotation is the dominant theme right now. The combination of steady rates and persistent inflation is forcing portfolio managers to reassess growth versus value positioning. Financial sector stocks, particularly banks and credit-related names, are attracting attention in this higher yield environment. Net interest margins expand when rates stay elevated, which benefits traditional banking operations. As reported by Seeking Alpha analyzing March FOMC implications, investors are rotating towards sectors that can benefit from yield curve steepening while maintaining defensive characteristics given the mixed economic signals. Defensive positioning is gaining traction. Sectors less sensitive to economic cyclicality are seeing inflows as traders hedge against the possibility that 0.7% GDP growth could deteriorate further. The Fed's pause doesn't eliminate recession risk, it just shifts the timeline. Cryptocurrency markets are telling a different story entirely. Bitcoin broke above $73,800, representing over 4% gains in recent sessions, according to ad hoc news coverage of the Fed rate pause impact on crypto. The technical breakout past the key resistance level of $71,800 is being viewed as a foundation for potential advances towards $75,400. Bitcoin ETF flows show $54 million in recent inflows, according to AI Invest analysis, signaling institutional capital is returning to digital assets. Why is crypto rallying when stocks are experiencing rotation pressure? The rate pause provides liquidity stability. Bitcoin and digital assets historically benefit from periods where the Fed isn't actively tightening. The current environment removes the headwind of rising rates, while the Fed's extended pause implies liquidity conditions won't deteriorate further. Crypto traders have increased the probability of at least one Fed rate cut this year from approximately 28% to 31%, with a 26% chance assigned to two cuts later in 2026, according to crypto market analysis of Fed policy expectations. That rate cut pricing is critical. Even though the Fed isn't cutting now, the market is starting to price in eventual easing as growth concerns mount. If economic data continues softening while inflation slowly moderates, the path to cuts later this year becomes clearer. Bitcoin is front-running that scenario. The $73,800 level needs to hold as support for the bullish thesis to remain intact. Cross-asset strategy right now requires monitoring multiple moving parts simultaneously. Bond market participants are laser-focused on long-term yield movements as signals for changing inflation expectations. If the 10-year pushes above 4.5%, that's a major signal that inflation expectations are becoming unanchored. Equity sector rotation trades are live right now. Growth to value shifts based on yield curve dynamics and inflation trajectory. If yields continue climbing, growth names with high valuations face compression. Value names with current earnings and dividend yields become relatively more attractive. Financial sector positioning makes sense in a higher for longer rate environment. Defensive sectors provide downside protection if growth continues decelerating. Cryptocurrency technical analysis is increasingly combined with macroeconomic policy signals. The Bitcoin chart matters, but so does the Fed's policy trajectory and institutional flow patterns. Digital asset positioning requires acknowledging both the technical breakout above $73,800 and the macro backdrop of potential rate cuts priced for later this year. If risk appetite holds and liquidity conditions remain stable, crypto can extend gains. If geopolitical risks escalate or commodity price volatility intensifies, as Powell warned, digital assets could face sharp reversals. Risk management in this environment means acknowledging what we know and what remains uncertain. We know the Fed is paused at 3.5 to 3.75%. We know core PCE inflation at 3.1% is well above target. We know GDP growth revised to 0.7% shows economic softening. We know Bitcoin broke resistance at $73,800 with institutional inflows returning. What's uncertain is the inflation trajectory from here. Does it continue moderating slowly, allowing the Fed to eventually cut? Or does it re-accelerate, forcing the Fed to hold rates higher for even longer? The geopolitical and commodity price risks Powell highlighted add volatility to that inflation path. The Fed's explicitly data-dependent stance means trading strategies across all asset classes are increasingly sensitive to each inflation release and growth indicator. Personal consumption expenditures reports, CPI prints, employment data, and GDP revisions all carry market-moving weight. The March inflation data showing 2.4% CPI, but 3.1% core PCE illustrates why the Fed can't declare victory yet. Treasury markets are pricing in this uncertainty through elevated long-end yields. The 30-year at 4.91% reflects bond traders demanding compensation for inflation risk. Equity markets are navigating sector rotation as investors reposition for a higher for longer scenario while maintaining optionality for eventual cuts. Crypto markets are betting on liquidity stability and positioning for potential easing later in 2026. Current market positioning is anchored by these key metrics: federal funds rate at 3.5 to 3.75%, inflation gap with core PCE at 3.1% versus the 2% target, economic growth at 0.7% showing deceleration, and the 10-year, 30-year Treasury spread reflecting ongoing inflation premium concerns. Forward-looking indicators to monitor include Treasury yield technical levels that could signal major repricing events, inflation expectation anchoring as measured through market-based indicators, cryptocurrency institutional flow patterns as risk appetite measures, and sector rotation momentum in equity markets. The trading environment as of today, March 19, 2026, requires sophisticated cross-asset strategies that account for the Fed's data-dependent approach and the ongoing tension between economic growth concerns and inflation persistence. Markets are operating with policy stability, but not policy clarity. Bond traders are positioning for potential yield breakouts. Equity investors are rotating between sectors based on rate trajectory assumptions. Crypto traders are front-running eventual Fed easing while managing near-term volatility. Each asset class is responding to the same Fed policy framework, but expressing different views on how inflation and growth will evolve. The key inflection point to watch is whether inflation continues its slow decline or stabilizes at current elevated levels. If core PCE remains stuck near 3%, the Fed stays paused indefinitely. If inflation accelerates, the Fed considers resuming hikes despite growth concerns. If inflation finally breaks lower toward 2%, rate cuts come into view and risk assets rally. Position sizing matters in this environment. Conviction trades require acknowledging the range of potential outcomes and managing exposure accordingly. The Fed pause provides breathing room, but not a clear directional signal. Markets are navigating that ambiguity through sector rotation, duration positioning, and tactical crypto exposure. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.